Talk about the basics of mortgage credit, which is different than the credit you see on Credit Karma. It's different than the credit score you may see when you are getting a car loan, those kind of things. We're just focusing on mortgage credit. First of all, the score options are from 300 to 850. In general, some loan programs have different requirements, but in general, kind of you can go down to 580. Some programs you can go lower. There's different things, but in general, the scores run from 300 to 850. Obviously, the higher up you are, not only is it easier to qualify you, but chances are you're going to save money. But the minimum, if you're 580, in general, that's kind of what mortgage people will ask for at a minimum. And it doesn't necessarily mean if you have bad credit that you can't get a loan. What it means is that it may cost you more. You may have to have some other things involved, like a greater down payment or those kind of things. So when we pull, as a mortgage professional, when I pull a credit report, there is three bureaus we pull credit from: Experian, Equifax, and Transunion. So we take those three and we take the middle score. So let's say your Experian is 750, your Equifax is 740, and your Transunion is 760. We're going to use the Experian because that's the middle score. And every time we're going to use the middle score on your credit. So sometimes I'll have people come to me and say, hey, my credit on this thing is 780, and that will be the high score that we see on their credit report, but we have to use the middle score for the mortgage purposes. If there's only two scores for whatever reason, we're going to use the lowest one. Okay, so there's three scores or three bureaus that we pull scores from. We take the middle one. Well, why are the scores different for Experian, Equifax, and TransUnion? Credit companies, credit cards, car loan companies, all those kind of things report at different dates to those companies. Some report to only Experian or TransUnion or Equifax, and so they're all going to be a little bit different, and that's why we're going to use the middle one. Okay. Again, we're going to take the middle score. Now, the other thing I get probably on half the credit reports I pull or in half the conversations I have with a potential home buyer is, well, my Credit Karma score is so on and so forth. And then I pull their credit and they're shocked that typically it's a little bit lower when we pull our report than what their Credit Karma says or whatever. They use a completely different algorithm. That algorithm probably has different reporting dates. They may update it more frequently, those kind of things. The FICO thing that we use reports once a month. And so those kind of things you're not going to be able to get. Let's say you pay down a card, and we're going to talk about that in a minute. Those things aren't going to go until that credit company reports to the bureau, and the bureau reports to our credit stuff. So Credit Karma is going to be different. Don't go by that in terms of, it's a good starting point, but chances are when you get to credit, it's going to be different for the mortgage professional. And so be patient with that, but use that as kind of your starting point, and then go forward with the mortgage if that's what you want to do. Okay. Now, how are scores created? Okay. So how are the FICO scores created? 35% of it is payment history, meaning do you pay on time? Are you current on all of your cards? That's the big one. So if you miss a payment, your score is going to drop significantly because it's over a third of the creation of the score. So if you do somehow miss a score or miss a payment, the first thing you need to do to fix your credit is get that thing current as quick as possible. If you're late and then there's rolling lates, then your credit's really going to be in trouble. Okay. And then the next thing, which is 30%, is amounts owed. Meaning if you have a high balance to a credit limit ratio on a card, that's going to affect your score. If you keep it below 30%, some say 10% is kind of perfect, then that's going to help your score. So one of the quick things you can do to pay off or to improve your scores is to pay down balances. Now, make sure you talk with a mortgage professional, because most of us have credit tools, and if we can't help you, we'll refer you to a credit professional that can help you. But before you start going to pay off stuff, talk with a credit professional and we can run you through a credit simulator to see which ones are going to help you the fastest. The credit mix is 10%. Credit mix is, do you have car loans? Do you have revolving credit cards, those kind of things? So, or is it all just student loans? Is that the only thing on your credit? Is it all just car loans, or is it all just credit card debt? We want to see a mix of those kind of things to help improve your score. New credit is 10%. And one of these things, we get a lot here is like, well, I don't want a hard inquiry on my credit. First of all, the new credit, and that's where the inquiries fall, is only 10% of your credit. Now, those inquiries roll off after 120 days because that's when your credit stuff expires. Okay, so if you have a hard inquiry, it's not going to crush you because it's only 10% of your credit. If you have a lot of hard inquiries, then it's gonna show some. Basically, at the end of the day, all these things are: is this person responsible with their credit? If you have a lot of hard inquiries, then there's going to be some trouble. Then it's going to start affecting your credit. Now, one thing you need to know that if you are, let's say you get a mortgage inquiry, and then you go down the next week and you're shopping for a mortgage, you have anywhere up to 30 days. I would keep it in the 10 to 15 day range to pull as many people as credit as many times. It only counts as one inside of the same industry. So this is if you're doing a car loan, if you're doing a mortgage loan, anything inside of there only counts as one hard credit pull. Okay, so again, it's not going to affect your score that much because it's not a bad thing until it becomes a bad thing, right? Until you have too many inquiries and those kind of things. And then the last thing is 15% is length of credit, meaning how long have you had this credit? So let's say you paid off a card that had a super long balance, like you've had this card for 10 years and you've had a good pay history on it, which is great. You paid it off and then you closed it. Now that length of credit has shortened. So don't always just assume like, hey, I'm just going to pay this off because I've had it so long and I don't want it anymore or whatever. If you pay that off and you close it, your length of history is now shortened. So this goes not only on individual cards, but it goes on all of your credit. So that's one thing to note. And then if you're establishing credit, one of the things they're going to do is like the longer you have credit, you're just going to see your credit continuing to improve as long as you make your payments on time, as long as you keep your balances low, as long as you build up a decent credit mix, as long as you have some new credit every once in a while, and as long as, again, that credit history lengthens and is solid, okay? So one of the things I'm going to say to you is that if you, let's say you pay off all your cards and you don't use them, eventually your score is going to go down if you're not using your credit as well, okay? So again, at the end of the day, our scores are different than Credit Karma. They're different than the car loan you got. They're different than anything. It's mortgage specific. And we use the FICO model. We use Experian, Equifax, and Transunion. We take the mid score, and this is how your credit is created. Before you go to get your credit pulled with a mortgage professional, see it, find out if you know you have any disputes on your credit. It's probably going to be better for you to take those off prior to having your credit pulled. It'll just be easier because we can't have any non-medical collection disputes on your credit. So if there's a medical dispute on your credit, you can leave that on there. But if you're disputing a card because they got you because of the payment or whatever, you need to remove that dispute, because that removes the negative, whatever it is, from your credit. Okay, and then collections. What I would suggest is don't pay those off until you have your mortgage professional pull your credit. And the reason is, a lot of times when you pay a collection off, it's going to reactivate that in your credit. Once they hit you with a collection on your credit, it just sits there and then it gets better over time. But if every time it comes up, whether they call you and you answer the phone or you pay it off, it reinvigorates that credit, and it may not be helpful for you. So before you pay off your collections, talk to a mortgage person and make sure that that's actually going to help you before you do that. Unless you're going to get a pay for delete and they're going to remove it. Once you pay it, they're going to delete that from your credit report, which is an option as well. Again, you're going to need to talk to them. You're also going to may need to talk to a credit professional before you do that. But what I would suggest is talk to a mortgage person before you do that, especially if you're planning on buying a home and you need this home quickly or so on and so forth. So good luck out there. If you have any questions on credit, would you qualify with your current score? You have a certain item that we didn't discuss in this video on your credit, please don't hesitate to reach out. Hit that subscribe button below. We'll talk to you soon.